happy to have you here. We spoke before in the past, and I really thought that, in our last conversation that we had, that your insight and perspective and your expertise in the channel was kind of a little bit different than what I was accustomed to. So I thought it'd be a really great opportunity to bring you onto the podcast and highlight your expertise and introduce the marketplace for those who haven't met you to you. And if you like, I think that would be a really great time for you to just kind of tell us a little bit about yourself, and we'll just go from there.
Okay. Yeah, thanks, Dmitrius. Yeah, we've had some really good conversations, and I'm really impressed with what you're doing with xAmplify. Uh, there's a lot of need to professionalize the channel, and I think what you're doing is going to help a lot of companies do a much better job with their channel partners. I've been in the channel business for about 30 years. My background is actually in banking and finance. So as you'll see as we get into the conversation, I take a very financial, analytical look at it. I don't come at it from a sales perspective. I don't come at it from a technology perspective. And at the end of the day, companies need to make money, and the channels are simply one way of doing that. Let's just back up a little bit because people use the word channels to mean a lot of different things. And channels is a very broad word for how you go to market. There are direct channels, which is your direct sales, your sales force selling over the web, but where you're selling directly to the customer. And everything else is an indirect channel, where there are some third-party elements, whether they're referral partners, they are agents, resellers, distributors, VARs, SIs. Everything else falls into that other bucket of indirect channels, and that's where our focus is. So we started out doing channel development. I was living in France at the time, and we're working with US companies that were expanding internationally. And we had a network of people across Europe that spoke the language, understood the culture. And so we were actually doing the heavy lifting for companies, where we would take on an engagement for a US company, typically early stage companies that were expanding, had some VC funding. And we would do the heavy lifting of actually building out the channel, recruiting partners, contacting them. And the early days, we didn't know what we were doing any more than the ISVs did. But because of my background, we started to document the things that worked and all of the things that didn't. And one of the things that was frustrating for us as an intermediary on behalf of our clients was that we were not producing consistent results. And I couldn't understand why. So we would have an ISV with a really cool solution, and we'd recruit, let's say we recruited 30 or 50 partners. And we found consistently that 5 to 10 of those partners were doing a really good job with the product, and the others weren't. But they all fit the same profile. So they're all working with the same solution. The partners all had the same profile. So we said, why aren't they all being successful? And that's when we sat down and we'd worked with several dozen companies. We set up hundreds of relationships around the world. And we sat down, we just took time off and we analyzed every single partner relationship that we had established to find out why were they successful when they were successful and why weren't they when they weren't. And we had a couple of kind of epiphanies from that. One thing that we realized was that the outcome was typically very binary. Either the partner took a product on and became a strategic part of their business, and they generated hundreds of thousands, some cases millions of dollars in revenues. It became a strategic part of their business, or you weren't. You were simply part of their portfolio. There were very rarely was there a middle ground where, when we got into the business, we thought, okay, we're going to have 10 partners. One partner won't sell anything, one will sell one will sell two, one will sell three, and so on. That there would be a linear progression in the performance of the partners. And what we found was that no, it was very binary. Either they sold a bunch of your stuff or they didn't sell much at all. And that's when we realized that it's because the companies that were successful made a real investment. They made investment in training and learning the product, sales and marketing, and became a part of their regular rhythm of business. And the others were focusing on two or three other products, and our customer was just a nice to have in case somebody asked for that particular functionality, but they weren't making that investment. And so when we saw that, we realized that, okay, so there are two types of partners essentially, strategic partners and opportunistic partners. And so we really started to focus on how do we make the partner organization much more focused on strategic partners, having a larger percentage of the partners be strategic and be performing. And as we went through it, we also realized that we were approaching the partner recruitment in the same way that our clients were, with this arrogance about the technology. And you've probably seen this as well.
Mm-hmm,
Now,
mm-hmm.
every technologist, every product developer that comes out, the best thing the world has ever seen, and they go to the channel and say, hey, hey, you guys, we're the only product that does blah 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 because they've all read Crossing the Chasm. So we are the only product that does blah blah blah, and you should be grateful for the opportunity to represent us because we're going to make you successful.
Harold, you have no idea how many times I've heard a I heard the term "we're the only."
Yeah, right, right,
Right.
yeah,
But I have a quick question because you do have this very unique background coming out of finance, and I believe you worked in investment banking in the
yeah,
past.
yeah.
So I kind of want to drill down on how you segued from investment banking into the channel, and what elements from your finance background, right, and working
Yeah.
in banking did you bring into the channel in order to improve it?
Okay, so I'll give you the short version of it. When I was doing investment banking, we were also doing franchising, master franchising around the world for our clients. And one of the companies that we represented was in the early business of a computer franchise, back when they had Computerland and those types of companies, and they were expanding into Europe. And we set up a partnership for them with a large French company to represent them across Europe, and they needed someone to do the business development for that joint venture. I was living in Phoenix at the time. I'm from Norway originally. I lived in Phoenix for 12 years, got tired of the heat and the monotony of being in Phoenix. And so when I had a chance to go to Paris for what was going to be a 1 year gig to run the European business development, I said, yeah, we'll do that. So my wife and I packed up and went to Europe. And because of that engagement, that was my first real exposure to the technology sector. I ended up with a large network of contacts in the reseller and distribution community across Europe, and we realized that there's a real opportunity here because we could see all of these US software companies that were all making the same mistakes and that they needed somebody on the ground, people that spoke the language, understood the culture. So that's how we segued into doing the channel development for ISVs. But the perspective is always on, so how do these ISVs maximize their value? At the end of
Mm-hmm.
the day, you go into business not because, well, there is an element is we want to make the world a better place, but as a business founder, as an owner, you want an exit at some point. And so one of the first things we do when we sit down with an ISV is that, so what is your exit strategy? Do you have one? Do you want to be a lifestyle company? Do you think you will be able to grow the company to do an IPO? And there are a lot of markets, Israel, South Africa, Australia, where you can, India, where you can IPO your company at a fairly early stage. You can't do that in the US anymore. Or are you going to do a trade sale? And that defines what the go-to-market strategy should be. If it's going to be a trade sale, then you have to understand, okay, so why is somebody going to buy you? Is it because you have this really cool technology and you'll save somebody 6 to 18 months in development time? They're going to pay a big premium on zero revenue in order to buy that technology and get an early start. That's a very small percentage of ISVs. Most of them are going to be sold because they have some type of market presence. And the acquirer will be buying them because they have a customer base. And if they have that customer base, our perspective was, well, you need to build that customer base in a market where it's most likely the vendor, the company that buys you, will have a white space. So don't focus on the US. Focus on markets in Europe or Asia where you can build up a strong customer base, and that becomes the value driver. Someone that's really coming out of the US that doesn't have a footprint in Asia, doesn't have a footprint in Europe, will pay a premium to buy your customers in those markets instead of having to build up their own organization. So once we understand where they want to go as a founder, then we can develop the go-to-market strategy. And if they're going international, channels are just the best, most cost-effective way to do it.
That really I have to drill down on this because I do have some experience in the M&A space.
Yeah,
So when you're evaluating a company who has a very large channel program and as a target, and you're trying to assess the value of this company based on the revenue. Now, when you look at their partner program and you're seeing all these partners who are acquiring these contracts, like how does that differ in the traditional sense where, let's say for instance, here in the United States there's a particular target, and let's say they have a handful of government contracts, and those contracts aren't going anywhere for 10 years. like
yeah,
like how do you negotiate uh those sort of contracts against like a contracts within a partner program where
mhm,
you have no idea what's going to happen with those partners, right? If they're going to stay
yeah,
committed, loyal, versus these are technically your clients. when you're working in direct sales?
Yeah, yeah, that's an interesting one. What you're talking about effectively is what is the churn rate? If you have a
Hmm.
government contract and you're baked in, your churn rate is going to be very low. If you're going through partners and your customer relationships are based on the partner relationship with the customers, that introduces a new variable and a new risk. Does the customer provide the same level of customer success that you do? Do they have the same quality of relationship? And so you build up those metrics over time, and that becomes also. And now we'll as we move forward, we'll talk about the scorecarding. That's one of the ways that you measure your partners. When you're going through partners, you are absolutely dependent on their reputation and how they deal with their customers. They are effectively an extension of you, and how they represent you is a reflection on you. So if you have a partner that has a high churn rate, they have a low close rate, they have a lot of turnover in their sales staff, that company is going to be a very poor reflection of your brand in that marketplace, but they effectively are your brand ambassador. So in looking at the quality of the channel, you have to look at a number of elements. One is the ability to drive revenues. But most importantly, and from the valuation perspective, is their ability to drive retention and provide customer success. So in analyzing, and this is where a lot of ISVs run into trouble over time, is that they built up this network of hundreds, in some cases thousands of partners, and they don't really have a lot of quality control. It's a numbers game. Sign up enough partners in enough markets, and some subset of them will be successful enough that it covers the cost of the overall program. But when you think about it, and this is one of the things that we really drill down on with our clients, say, to look at the cost, look at the opportunity cost of having a non-performing partner in a market. And they said, well, what opportunity cost? We have a partner in Korea. We haven't heard from them in 3 years, but at some point they might come up with a deal. It's found money for us. I said, no, your brand has been in Korea for 3 years and no one has sold it. So Korea might not be strategic today. But now when you've covered Europe and you're looking at Asia, and you decide that Korea is going to be more strategic, now you're going to go out and find another partner. So that partner knows that your product has been in the market for 3 years and no one has bought it. Now, is that a reflection on your product? Is it a reflection on the partner? Is it your messaging? Why is that? But it introduces an element of doubt about the quality of you as a vendor and your product. It's been in the market for 3 years and no one's bought it. That becomes something that the competition can use to hit you over the head when they're
Hmm.
standing in front of a customer.
Hmm.
Okay, this reseller, they're very successful with 4 other products. They have simply not been able to sell this one. Why is that? So the opportunity cost of having a non-performing partner in a market is huge. So back to your question, those are the types of things that ISVs should be analyzing on an ongoing basis.
Yeah,
Very,
yeah, real quick, you mentioned something. I want to drill down on this
yeah, yeah,
so
go
that the
ahead.
audience
Yeah,
doesn't get lost and we don't forget about it. But you mentioned assessing these partners with a scorecard. Can you
yeah.
kind of elaborate on this scorecard and how you've used this in order to determine where a partner is resting overall within a particular program and their effectiveness?
Sure. Yeah, because what happens over time is that the partners that were successful for you 10, 15 years ago, they went out and they got some net new logos because it was going to be a net new logo. They didn't have you from earlier. But what happens over time is that those partners want to milk their existing customer relationships. It's easier and more cost effective for them to drive more revenues from existing customers than to take your product out to get a net new logo. And this is why you see that the trend is, and more partners end up in the long tail where they're living on renewals, upsells, some cases participation and maintenance instead of driving net new logos. So it becomes really important for an ISV to maximize the potential revenues from their existing partner ecosystem. And what they tend to do is focus on the 5 to 10% that are driving almost all of the revenue. The sweet spot. And then they say, okay, now we've got these other 1,000 partners that will bring in a deal or a lead every once in a while. And because there's a lot of them, we'll get some revenue flow from it. But the cost of maintaining those partners is huge. And also one of the things that we've seen happen time and time again is that a company that's had a large partner program and they've had those partners for 10, 15, 20 years, as a partner performance starts to decline, at least in terms of net new logos, the margin doesn't change. And so we spend a lot of time working with companies on right sizing the margins. So you had a partner that did a lot of good work for you 10 years ago. They brought in those net new logos. They were your top tier partner. They got 30, 40% margin. And now they're just living on renewals. The revenue level is okay, but you're not seeing a lot of net new logo growth, which is what you need as a vendor. But they're still collecting 40%. Why? The 40% margin for resellers is to cover their cost of customer acquisition.
Mm-hmm.
And if they're not going out and acquiring new customers, they shouldn't be paid that 40%. So
Mm.
we developed a very comprehensive scorecard to go in and look at, and where we really focus on the long tail. The top performers, great. They'll do what they're going to do. They'll continue to perform for you. But there's more money to be made from improving the performance of the long tail partners or eliminating the ones that simply aren't going to grow for you than there is from trying to recruit new partners. And a lot of times when a company brings in a new channel chief, and you've seen this cycle as well,
Mm-hmm.
it's an 18 to 24-month cycle. They bring in a new channel chief and they say, here's our blob, here's our 500 partners. Your job is to grow the blob by 10%. So what do? They go out and try and recruit more partners to add to the blob. They go to the CFO and they ask for a budget for an MDF program or a SPIF program or upgrading the PRM system or something. And they find out after 12 months that they're not really moving the dial. All they're doing is adding more non-productive partners to the blob. And then they spend the next 6 to 12 months trying to defend their position. Finally, management said, hey, you missed your target, you're out. They bring someone else in and it's rinse and repeat. Because the people that they bring in didn't have responsibility for building up that inefficiency over the last 10 years. They're just inheriting it. So no one really has an incentive to look back and say, well, how do we fix the problems that are inherent in our existing partner ecosystem?
Mm-hmm.
Because there's more money to be made there. I mean, we've worked with companies that where we've been through that process, and they've freed up millions in revenue recapture simply by going in and analyzing the partners that shouldn't be getting the legacy percentage of 20, 30, 40% because they effectively only living on their the clipping coupons on the existing customer base or bringing in referrals. Cut them down to 10%, and the margin recapture is phenomenal. Also, identify one of the things we go is so partners are long tail partners for different reasons. And we want to identify why are they long tail partner. And the categories are small shops, 1 and 2 man shops that don't have the ability to scale no matter what you want to do with them. Then there are partners that have changed their strategic direction. They used to be really strong in SharePoint, and you've got a SharePoint-based solution, and now all they do is cybersecurity. They have pivoted their business in a direction that is simply incompatible with what your technology does. You'll never get them back to becoming a strategic partner. Then there are partners that were really good with your on-prem solution 10 years ago. You've moved to SaaS, and they haven't changed their business model. There are partners that are large, good partners, but they focus on your competition. We see this in cybersecurity all the time, where they will be an F5 or Checkpoint or Proofpoint, or they'll have one primary brand that drives their business and they're a top tier partner for that vendor, but they have another 5 vendors because they have to have that in their portfolio. If you can convert them to becoming that strategic partner and you become their number one or number two product, it has a dramatic impact on your performance. So we go through and say, well, if they're a small shop that will never scale, or they're a company that changed their strategic direction, why do you even keep them in the partner portfolio? Dump them,
Mm-hmm.
capture that market. Now, this also comes back to your question earlier. ISVs need to have a mechanism to be able to assume the direct relationship with the customer when the partner doesn't work out. So if you're unhappy with a partner because of their sales or their poor customer success, or just because they were dishonest, you need to have a mechanism in place that allows you to terminate the partner and take over the license agreement directly with the customer.
Mm-hmm.
Uh, and if ISVs are not doing this type of ongoing quality control, they're just leaving a ton of money on the table. It also makes the CFO a lot happier if
Mm-hmm.
you, as a channel manager, can go to the CFO and say, "Hey, here's a rigorous data-driven analysis that I've gone through. We can free up 2 million in cash flow by making these adjustments. Now give me 500,000 of that to go out and drive more performance from the partners that can be reactivated." That's a much more compelling story than going to the CFO and saying, No, we've got 1,000 non-performing partners, so let's just throw some more money at them. Let's throw some spiff at them. Let's throw an MDF program out there. Let's do stuff that costs money without having a clear path to a return on that investment.
So for that's so I kind of want to drill down on something because you mentioned something and I kind of want to understand the process a bit more in depth. So and correct me if I'm wrong. And I'm just trying to restate what you said. I believe that you said that when you find these partners that are no longer necessarily performing or finding net new business and just sitting on an account, right?
Yeah,
That after a while you can go back, you can reassess that relationship and take over that account, right? Because
in some cases, yeah,
you're paying out this partner. So what does that process look like in real time? And
yeah.
before you get to that point, are there anything you can is there anything that you've seen that can be done in order to enable that partner and get that partner reactivated and go out there and find that new
Yeah,
business?
those are two sides of the same question. So
Mhm.
it's a great question the way you phrased it. So in the analysis, you want to identify the partners that have the potential to be reactivated. So you want to eliminate the ones that are dishonest, the one to two man shops, or have changed their strategic direction. You're never going to be able to activate them. So just drop them from the program. They're a waste of space and resources and mind share from you. Now you look at the ones that still have the potential. They're the ones that had one salesperson that loved your product, and that salesperson left 2 years ago, and all of a sudden sales dropped off a cliff, but they still have the right profile. It's just that no one picked up the ball and backfilled that role. Can you go back to them? The ones that represent your competition. So for the long tail partners that have the potential, you feel have the potential to do better than they're doing, or the companies that didn't make the move from on-prem to SaaS, can you help them with their business model? So for each of those profiles where they have the potential to be reactivated, you just don't cut them off at the knees, because there's some legal issues as well, and just arbitrarily making changes. But you can go back to them and say, hey, we know that you were really good 3 years ago. You lost a salesperson. Let's put together a co-funded business plan. We will co-fund a new salesperson with you for 6 months. And then if you
Mm.
do that and you can hit 3 net new logos in the next 6 months, then we'll let you keep your historical margin, whether that's 30, 40%. Then you can keep that margin because now you're producing net new logos. But it's up to you, Mr. Partner, to opt in or opt out. So you go to them with that choice, and if they opt out, but you still want to keep them because they have the right profile, they understand your technology well enough, not to be wasting your time and resources, then you move them to 10%. So the partner has a choice. Do we make an investment and then just up our game for this vendor and maintain our margin? And if they're getting 30 to 40% on $500,000 of recurring revenues historically, then they probably want to do that to safeguard that investment. Or do they say, no, it's just not worth it. We've moved in a different direction and we're not going to make that investment with you. So we'll take the 10%. Now, are they going to be happy? No, they're going to be pissed off, of course.
You know,
But they won't have much of a choice. It's either do we keep the 10% or not? So
it's so funny. There's a term in sales organizations, right? Especially with the top performers. Sometimes it's with the top performers who have a host of accounts that are just generating revenue, and it's called resting on your laurels, right?
yeah,
Where
yeah, yeah,
you're just sitting back, relaxing, resting on your laurels. You already have the money coming in, and it's like, wait a minute. You
right.
got to go out there and get some net new business, right? You have to inspire and motivate the people around you. You got to keep growing. You got to keep pushing, right? Because if you're not
Yeah.
growing, you're shrinking, right?
Yeah, yeah, that's a really good point, because one of the things that we always recommend when they're dealing with partners is to set the partner margins and incentives based on absolute revenues and net new logos in any 6 or 12 month period. So they can't maintain their margin structure unless they also hit the net new logo target as well. Because you do get that where partners build up to the point where they're doing 500,000 and most of it is recurring. And you think, great, that's a great performing partner, they're doing 500,000. But when you analyze it, they're not adding net new logos. As a vendor, your growth is going to come from partners out there investing in their own sales and marketing, absorbing the customer acquisition costs to drive those net new logos.
Mm.
So absolutely. Yeah.
So we're coming up to like the top of the hour here. But what I
Okay.
would like to do now, Harold, I would like for you to just for the Sigma podcast, just tell people like how they can get in touch with you, but most importantly, not how they also can how they can get in touch with you, but what they can do today to start assessing the effectiveness and the viability of their partner program, and what steps they can take today in addition to that that can help them improve its efficiency.
Sure. So one thing is, on our website, we have a free calculator, a break even, partner break even calculator. www.theyorkgroup.com, and they'll be able to find a calculator where they can go in. And for a lot of companies, they simply don't know how much it's costing them to support their partners. They know how they have 500, 600 partners, but if they're in a hybrid direct and indirect model, they may not be splitting out the costs or calculating the actual cost associated. So use the calculator, and that will give you a really good indication of, are you running a good partner program or not? If you find that 80% of your partners are producing revenues lower than the break-even point, you have a problem. If 80% of your partners are above the break-even, you're probably doing a lot of things right. So that's a really good first diagnosis to see if they have a systemic issue with their channel program. And if they do, then we can come in, because then we can address that problem with the misalignment between the cost of supporting the partners and the revenues generated from those partners, and making the partner organization a lot more efficient.
That's fantastic. And I think as we're coming to like the end, or we're approaching the end of the year, going to the holidays, there are a lot of partner programs that are going to start reevaluating, right?
Yeah, yeah.
Their performance as of this last year. And, I think having that sort of an insight can give them some tools to figure out what they're doing wrong, what they're doing right, and where they can make improvements. But I do strongly think they should reach out to you, go to your website at least, and use the calculator. But aside from that, are you ready for the holidays or ready for Thanksgiving?
Yes, yeah. Now, I'm from Norway originally, so Thanksgiving has never really been, and I lived in France for a long time. But yeah, it's going to be a nice little break.
I would say this much. I love Thanksgiving just because I love the sight of like a bunch of food, but
Yeah.
I'm not a big turkey eater.
Okay.
That tryptophan, I remember reading in a reading comprehension sort of section of a test. I'd always read about tryptophan. I think it was like on the LSAT. It could have been the LSAT or some sort of standardized test. There was this reading comprehension sort of blog about tryptophan in turkey and how it makes people sleepy. So right, so like whenever I see
yeah.
turkey, I just think about that reading comprehension prompt, right, and about
Well,
tryptophan and turkey, and I get completely traumatized. I've read that thing about maybe 30 times. I think I was studying for the LSAT, so it's like just trauma on trauma on trauma. No turkey for me.
So that's why you see people nodding off on the sofa at 5 o'clock when they're watching a
Yeah,
football game.
so I'm like, hey, do you have any? Can
Well,
someone
you
just
killed
prepare
one,
some roast?
Demetrius. You just killed the Thanksgiving for a lot of your listeners.
Hey, you know what? Hey, hey, listen, it's true. Trust me. They made a compelling argument in this reading comprehension sort of blog, on the L side, and I'll never forget it. It's just how tryptophan makes you sleepy. So for me, like I said, when I see turkey, it's trauma on trauma. But but Harold, it was really great having you. Can't wait to bring your expertise to the marketplace, and I'm so glad you joined the platform today.
Yeah,
And
thanks for inviting me, Demetrius. I really
it's always a
appreciate
pleasure
it.
talking to you. You have such a great, unique insight into the channel. And I think your expertise provides a fresh and net new perspective on how we can be more efficient and more effective.
Well, thank you very much.
All right. Well, we'll talk to you again soon. And everybody
Alrighty.
who's listening, thanks for joining us today.
Thank you.
All right. Bye-bye. All right, Rajiv.
Yep.
So you can probably cut like this and probably edit it, but
Yeah.
yeah. But yeah, so Harold, thanks for that was